Hi folks, welcome to this short video which is going to show us how to go from an adjusted trial balance to an adjusted trial balance. So you'll remember from your studies in the first half of the course, and perhaps to date in our second half as well, that on the adjusted trial balance you will have a series of accounts that would show up on your balance sheet and on your income statement. In our case, the adjusted trial balance, it's going to reflect all of the transactions that have happened up to and including December 31st, 2009. So we have the account titles here. We have the debit and the credit balance in each of the accounts that are listed in the account titles column. You'll notice that in any trial balance, as in this one, you have the assets listed first with your current assets, then your non-current assets, in our case equipment. We have accounts payable and unearned revenue, which are both liabilities, current liabilities specifically. And we have a long-term liability, a note payable. And again, we know the note payable is non-current because it's not due until 2020. That's many years from our current year, 2009. And then we have our equity accounts in shareholders' equity, contributed capital, and retained earnings. You'll notice here at the bottom we would include our revenue and our expense accounts. When we look at the balances in each of these accounts as a result of the activity for the period, we have balances, net debit and net credit balances in each of the accounts. Our trial balance at this point balances to $60,700. Now, because we started off with a balanced position, we're in a better position that when we complete and get to our adjusted trial balance, we should wind up with an adjusted trial balance that balances as well. But in order to get from the unadjusted to the adjusted, we have to consider things that perhaps the company has not yet taken into account by the time they get to the end of the year, December 31st, 2009. We've referred to these kinds of items as adjusting entries. Adjusting entries, you'll recall, are entries that are made at the end of the period to make sure that all the balance sheet account balances are correct and that we include in the revenues and expenses any of those such items that have been incurred during the year but not yet recorded. You'll also remember that one key characteristic of an adjusting entry is that none of the entries that are adjusting entries would include cash. So let's look at examples of the items that are in need of adjustment that we would add to this trial balance in order to go from unadjusted to adjusted trial balance. So now, if you have a look at the first transaction they told us about, they said that on December the 31st, we had supplies that are costing $1,300 still on hand. Well, guess what? Our unadjusted trial balance is telling us that the balance in the supplies account is $8,400. But we've now gone and done a physical count, and our physical count tells us there's only $1,300 in supplies left. So what happens? It's just like when you have that late night craving for cookies. You have a package of cookies. What do you got in a package? Maybe 30 cookies. All of a sudden, you go to try and get a cookie and you find out your kids have eaten them all because there's only 3 cookies left. So that means somebody or some group of people in your family ate the other 27, right? Same thing here. We go at the end of the year and we find we've only got $1,300 in supplies left. So we have to make an adjusting entry to adjust the balance of supplies downward so that the ending balance is $1,300. Well, anytime you use up an asset, you have to book an expense, because when you have assets that you're using up, you have to book an expense. It's a cost of doing business. That's why you bought the supplies in the first place. You're going to use them to carry out your day-to-day business activities. So when you use up the asset known as supplies, you have to charge it off or debit a supplies expense account. But for how much? Well, for $7,100. So I'm going to debit supplies expense on December the 31st and credit my supplies account. How did I know it was $7,100? Because again, I started with $8,400 in the account, but I've only got $1,300 left. So if I started with $8,400 and only have $1,300 left, then that means I must have used up $7,100 in supplies. Now, if you find that a little confusing, some students like T accounts, some not. I like to sometimes draw it out in a T account to make sure it makes sense to you. If we started off with supplies at a debit balance of $8,400, which is what we were told here at December 31st, 09, but we know when we did fiscal count we've only got $1,300 left, how are you going to go from $8,400 here to $1,300 here? The only way that can possibly happen is if you use $7,100 of those supplies up, and that would represent a credit. So to go from $8,400 to $1,300 debit, we must have credited the supplies account $7,100. So that gives us the credit, and again the debit goes first, and that's the supplies expense. Now, let's look at another item that would have created an adjustment opportunity. It says here that we had purchased the equipment that we showed a balance for here of $28,000. We purchased it at the beginning of 2009, January 1st. The equipment has a residual value of $1,000 and an estimated life of 5 years. That's your clue that says I need to record depreciation expense. So what would our journal entry be? We would debit depreciation expense for $5,400 and credit our contra asset account accumulated depreciation for $5,400. So this is going to increase a contra asset account balance, and it's also going to decrease your asset balance. So how did we get $5,400? Well, we used the relationship that we talked about much earlier in our course, which is the calculation of depreciation expense for the year. That's cost of the asset less the residual divided by the useful life. Well, we're given all three pieces of information in our question. We know from our unadjusted trial balance that the cost of the equipment was $28,000. We know the residual from this piece of information is $1,000, and we know the useful life is 5 years. They've given it to us here. So if we do that math, we're going to get $5,400 in depreciation expense. So the adjusting entry to record depreciation on the equipment is a debit of $5,400 to depreciation expense and a credit to accumulated depreciation, the contra asset account, of $5,400. Now, let's go look at the next transaction. The next transaction said that we had insurance that we purchased on March the 1st, and that provides coverage for 12 months. Well, how much insurance did we purchase on March the 1st? Well, our unadjusted trial balance tells us that we paid for insurance $4,800. We prepaid it. So that means we paid up front, and during the year we were using up the benefit from that prepaid insurance, which is insurance coverage, right? So I've got this prepaid insurance asset, and I'm using it up. So whenever I use up an asset, I create an expense or a cost of doing business. I buy insurance because it's part of what I need to run my business, right? So if I'm using up that insurance through having insurance coverage during the year, that's a cost of doing my business. So the question becomes, how much of that prepaid insurance that I bought on March the 1st for $4,800 did I use up? Well, that's for 12 months. How do I know? The question told me I bought it on March the 1st, and it's giving me 12 months of coverage. So I have to figure out what's my new balance in the prepaid insurance account going to be. Well, I would say I'm using up $4,000 of prepaid insurance. How do I know that? Well, if you look down here, I know that coverage for 12 months goes from March the 1st, 2009 to February the 28th, 2010. But how much did we use up in 2009? Well, if that $4,800 was for 12 months, from March the 1st of 2009 to the end of December 31st, 2009, that's 10 months. That is 12 months of insurance, so I have to multiply it by 10 over 12 to prorate it to get it for 10 months. So that means I've used up $4,000 of the $4,800 in insurance. So I'm going to credit or reduce my prepaid insurance and book a cost of doing business, which is insurance expense, of $4,000. Now, what's the next transaction? Well, down here, they tell me that at December the 31st, 3/4 of the unearned revenue that I have on my unadjusted trial balance was earned during during 2009. So as at the end of December 31st, 2009, 3/4 of what I show on my unadjusted trial balance was earned. So don't forget, an unearned revenue is a liability. If we've earned the revenue or some part of that unearned revenue, we have to book it as revenue. The question is how much? Well, first of all, find out how much is on your unadjusted trial balance. Well, we know we have $3,000 in the unadjusted trial balance. If we go up here, unearned revenue, $3,000. But we used up or earned 3/4 of that unearned revenue. So 3/4 of 3,000 is $2,250. So that means I have to reduce my liability by $2,250 and book sales revenue during the period of $2,250. So I had $3,000 in unearned revenue to begin with. I'm using up $2,250. That's going to give me $750 on the adjusted trial balance in unearned revenue. That's remaining unearned revenue. So I just thought I'd type that in so that when you did your adjusted trial balance, you can now see how much you're going to have in your unearned revenue account. Okay, so I know adjusting entries can be tough for some students, but if you understand what an unearned revenue is, and you learn that in the first half of your course, that's a liability because somebody is giving you money in advance of you providing any product or service, right? So now if you're providing product or service from the date that you got that cash, you're in effect earning that revenue. So we have to shift it or reclassify it from unearned into earned revenue. Now, are there any other adjustments during the period? Yes, we have one here. It says employees were paid for work done up to December 27th, but there was some work they did from December 28th to 31st for which they have not yet been paid. And that represents $900 of wages that the employees have earned but have not yet been paid for. So the company has to debit their wage expense and credit wages payable to recognize the fact that the company has an obligation to pay those wages, but they're not going to pay them until January of 2010. So we're going to debit wage expense and we're going to credit wages payable. Notice so far, by the way, that none of these adjusting entries, if you go back through, none of them have affected cash. That's a key characteristic of adjusting entries. None of them will have cash in them. Okay, now, if we go beyond this, do we have any other adjustments? Yes, we do. We're told that interest incurred on that note payable, remember that note payable that we had up here in the unadjusted trial balance? It's not due till 2020, but we have interest on it. Any payable has interest on it if you've borrowed money from the bank. So it says here, interest incurred and owed in December is $200, but we haven't paid it yet. It's owed, but we didn't pay it yet. So we're going to debit interest expense for $200 and credit our liability account interest payable for $200. We have another transaction here related to dividends. It says there was a $500 dividend. It was declared on December the 27th, but we're not going to pay it for another 3 weeks. Well, another 3 weeks would take us into a new year, into 2010. So at the end of 2009, we've got to show that dividend that we declared, not only as being declared, but also as being payable. So our journal entry is going to debit dividends or dividends declared and credit dividends payable for $500. This is your liability, and don't forget dividends payable are a current liability, and this is your debit to dividends, or some of you might want to call it dividends declared. That's also an acceptable term. Now, we also have another adjustment. It says we've got some customers for which we have accounts receivable on, but they haven't paid us yet. Their accounts are past due. And we've earned interest on those overdue accounts receivable of $750. But we aren't going to be able to collect that $750. We don't collect it until next month. This is just what we've calculated at the end of December as the interest that on accounts that customers haven't paid. So that's the interest on those overdue accounts. So now the company would say, well, if our customers haven't paid us money that they've owed on their accounts receivable, we're now going to charge them interest on that account receivable. So we're going to debit interest receivable for $750 and credit, you got it, interest revenue. So we've created a receivable for interest, and we've also got interest revenue. You can see here the interest revenue is going to be part of our new income statement, right? When we do the income statement later on, it's going to be up there as part of our revenue. And this is going to be a new asset, interest receivable. Again, it's going to be collected next month, so the receivable is a current asset. Now, let's see if we've got any more. And lo and behold, we have one more. It says here, income tax expense for 2009 was $315. They're not going to pay it until 2010. So now, in this case, how are we going to make the adjusting entry? Well, just to make sure you understand income tax expense, you know as an individual, anytime you earn income, if you work part-time, you really know what I'm talking about. You know that when you work part-time, you got to pay income tax. Well, corporations, when they earn income, they have to pay income tax too. All we're telling you here is that the income tax that they've incurred as a cost during the year but haven't yet paid Canada Revenue Agency is $315. They're going to pay it in 2010. So all we're going to do, all the company's going to do, is recognize the fact that they've incurred a cost of running their business, which we're going to show as income tax expense debit, and they owe the money later. Income tax payable gets credited because a liability represents the amount that we owe now, but we're going to pay later. So we're going to credit that for $315. So now we have all of our adjusting entries done. Now, the next thing we would do is we would prepare the adjusted trial balance. So you remember in the accounting cycle, after we prepare the unadjusted trial balance, which is what you did in the earlier part of the course, we make and post the adjusting entries. We've just gone through the adjusting entries. But now you'll notice that this adjusted trial balance looks very different from the unadjusted trial balance we had up here. Right? Looks very different than this. Why? Because you can see we've been adding accounts. We added supplies expense, right? We added depreciation expense and accumulated depreciation. None of these accounts existed up here. So what I've done for you, when you go to your adjusted trial balance, what I've done is I've highlighted in yellow any new accounts that we now have here. And I've included in red any existing accounts that we had before, but the balances have changed. So I guess I should have included this guy here. Balance has changed. So we never had interest receivable on the unadjusted, but we have it now. We never had accumulated depreciation or depreciation expense in the equipment, but we have it now because we made an adjusting entry for it. So you'll find that the adjusted trial balance, 99% of the time, will include significantly more accounts that have balances than maybe your unadjusted trial balance did, and it's because we're making these adjusting entries. You'll also notice that we had accounts before whose balances changed. So they've got new balances. Those ones I put in red. Your prepaid insurance, remember it was $4,800 before? Or what it was? Yeah, it was $4,800 before. Well, remember, we credited it $4,000 because we used up some insurance. So now we've only got $800 in it, right? So we had $4,800 in it, but we used up $4,000. So we've only got $800 left. So I can show you that just to go back a bit. You'll see here we had prepaid insurance, $4,800, but you'll remember we credited that account because we had to record the fact that we incurred a cost. We used up some prepaid insurance for $4,000. We did that calculation here. So $4,800 that we had less $4,000 we used up is $800. So you can go through and verify for yourself why these are all changing, but we know that to be the case. Your supplies, again, we explained that one. We had $8,400, but a physical count showed us we had $1,300 left. So that's all that remains in the asset account. So we show $1,300 here. Why? Because we debited supplies expense, which we showed here, and we credited supplies for $7,000. So again, we had $8,400 in the account. We used up $7,100. We know we used up $7,100 because the question told us we had $1,300 left. So again, you can go through, but what you're noticing here is that when I add up all the debits and all the credits, they are still balanced, $68,765. It's different than the balance we had in the unadjusted one up here, but that's because we've posted all of these adjusting entries. Now, just before we conclude the video, I just wanted to make sure that you see down here that I did not put the trial balance accounts in the adjusted trial balance in the order required, which means current assets, non-current assets, current liabilities, non-current liabilities, shareholders' equity accounts, and then revenues and expenses. I kept them jumbled up because nothing in life is perfect, and the next thing we're going to do in the next series of videos is make you go from the unadjusted trial balance to do the financial statements. So that will be our next video. I hope you found this video helpful.